Cheap dividend stocks are back now more than ever as the stock market continues to face headwinds. Due to the rising of interest rates in 2023, the cost to borrow money has also increased, making debt for companies much more expensive, and therefore, the possibility of fast growth for certain companies in the stock market are being affected quite a bit. In this video, we are going to go through 3 dividend stocks that are extremely cheap right now. Now, one thing to keep in mind, proceed with caution when it comes to these 3 different stocks. These 3 different dividend stocks have been beat up quite a bit, much more than other dividend stocks across the market. And that's because these 3 individual names do face their own individual headwinds, which have caused the stocks to drop a lot and which has caused their dividends to possibly be in jeopardy. But if the stock market can turn around sometime soon, and these names can dig themselves out the dirt, there could be some massive gains to be made. Now, like I said earlier, these stocks would be lower on the scale as far as dividend safety goes. Now, dividend safety refers to the likelihood that a company will be able to maintain or increase its dividend payments to shareholders in the future. It is important for investors who rely on dividend income to have a good understanding of a company's dividend safety, as a reduction or suspension of dividend payments can have a significant impact on their investment returns. And there are several factors that investors can consider to evaluate a company's dividend safety. Things like earnings, payout ratio, debt levels, the industry, and of course, economic factors. Now, like I said earlier, these stocks are on the lower end of the dividend safety meter. And this is because their dividends could be at jeopardy sometime soon. But again, if these companies are able to maintain and hold on tight until the economy, the market turns around, there could be massive compounding returns at stake here. So the first stock on the list is ticker symbol MPW, or Medical Property Trust. Now, MPW is a self-advised real estate investment trust formed in 2003 to acquire and develop net leased hospital facilities. From its inception in Birmingham, Alabama, the company has grown to become one of the world's largest owners of hospitals, with 431 facilities and roughly 43,000 licensed beds in 9 countries across 4 continents on a pro forma basis. And what's pretty crazy is that MPW is currently yielding a forward dividend yield of around 14.32%. MPW does also have a dividend growth of 10 years and pays a quarterly dividend of around 29 cents as of now. But MPW does face some massive headwinds. Medical Properties Trust recently announced a deal to sell its 11 Australian hospitals leased to Healthscope for roughly $800 million, the same price it paid to acquire this real estate deal in 2019. Now, proceeds from this sale will be used to prepay a term loan maturing in 2024 that MPW had taken out to fund its acquisition of Healthscope portfolio. This transaction improves MPW's liquidity, but will reduce the REIT's cash flow, as these 11 hospitals contributed approximately $54 million of rent, or 3.7% of the total revenue, but annual interest on the 2.45% term loan was just $20 million. So if management wanted to deleverage MPW's balance sheet with more urgency because of this, a dividend reduction could perhaps be right around the corner because of this loss in cash flow. But if MPW can raise some more cash in the meantime, or figure out some way to keep kicking the can on the road, this 14.32% starting dividend yield could make dividend investors a fortune. The next stock that is yielding over 14%, but does also face some headwinds, is ticker symbol ABR, Arbor Realty Trust. Now, Arbor Realty Trust invests in a diversified portfolio of structured financed assets in the multifamily, single-family rental, and commercial real estate markets across the United States. ABR's current forward dividend yield is 14.61%, which is massive. It also has a dividend growth of 9 years and pays around 40 cents every single quarter. But shares of Arbor Realty Trust have been tumbling for a while now, and this is likely reflecting concerns about the mortgage REIT's structured loans portfolio as recession fears continue to mount. This part of the business generates around 30 to 40% of all of Arbor's earnings, and mostly provides floating rate bridge loans to real estate owners and developers who need short-term funding, most of the time around 1 to 3 years. With mortgage rates rising at the fastest pace that we've seen in a long time, and the anxiety growing about the economic downturn, some of Arbor's highly leveraged borrowers could face tough refinancing conditions. And when these borrowers see their bridge loans maturing, they could be at their risk of default. So Arbor Realty Trust is another one that's been beat up like crazy in 2023, but for those with a faint of heart, they could get in and see a starting dividend yield of 14.61%. Now, will ABR cut their dividend sometime soon here? It's possible, especially with the conditions of the market, but only time will tell. The last dividend stock that we're going to go over that is too cheap to pass up right now, possibly, could be Omega Healthcare Investors. So ticker symbol OHI is another healthcare REIT with a starting dividend forward yield of 9.81%, so pretty close to 10% starting yield. Now, OHI has 0 years of dividend growth and pays around a 67-cent per quarter dividend. Recently, OHI posted an investor presentation warning of a cash flow decline for the first quarter of 2023. In the update, Omega proposed significant restructurings for 2 of its largest tenants, and OHI is scrambling, trying to move things around in order to stabilize the cash flow for investors. So even though the future is looking semi-uncertain for OHI, this could be another dividend REIT to nibble at that's willing to risk the possibility of dividend cuts, but for those that are hoping that OHI can make it through the storm. So there we have it. Those were 3 different dividend stocks that might be too cheap to pass up in 2023. Now, like we said earlier, these stocks do come with their own risks, as all dividend stocks do. But for those investors out there with a little bit bigger of an appetite of risk and or future dividend cuts, these could be some names that you could buy now and possibly, of course only possibly, see some major gains in the future. If you enjoyed this video, make sure to please drop a like in the video and subscribe for more.